Nice location to have a little presentation, right? I was looking forward to the location as much as anything else. Not glad to have you here, but I am going to have a beer at the end of the day, so that'll be fun. Nice to be here. I'll give my introduction later, but the way this is going to work is Jeff and I, we got 4 sponsors here. Jeff and I have spent a lot of time working on this together, along with our other 2 co-sponsors. I'll introduce everybody. We're going to kind of go for about an hour and a half now, or 2.5 hours, sorry, just got the time wrong. Let's make it like a well-run ESOP company here, and let's have some interaction. We don't want to sit here, all of us that have been doing this, I mean, Jeff and I have known each other for 35 years. I've known Steve Nelson Nelly for 25 years. Mike Penkulski with J.P. Morgan, again, known him over 2 decades. We don't want to sit here and just talk at you all day long. We'd like to answer the questions that make sense to you. So please interrupt as we go. Don't let us just get into our by-rote presentations. I've and what we'll do some housekeeping at the end. There are some forms we'd like you to fill out. You know, this is approved for CLA credit for anybody who needs that. Please sign in at the front. I've gotten the nice task of introducing the speakers today. And again, a lot of these guys are folks that I've worked with for a long time. I'm glad to be here and glad to have the opportunity. I'm going to give the formal introductions to the speakers, and I'm going to have the informal one, because I've got some thoughts about that too. But Jeff Cairns, known him for a long time, 3.5 decades, a real true professional. Jeff is he is a partner at Stinson in their Minneapolis office. Jeff is an attorney. He's also a CPA. Jeff regularly advises employers, trustees, and administrators in the design, administration, and voluntary correction of employer-sponsored benefit plans, including 401k plans, 403b plans, ESOPs, deferred compensation plans, health, life, and disability plans. Jeff's a graduate of William Mitchell College of Law. He's also a former member of their board of trustees. Jeff has been recognized for many years, and I was impressed when I read this bio last night. I respect Jeff a lot, but it's an impressive bio. Has been recognized for many years as a Minnesota super lawyer by Minnesota Law and Politics, and since 2009 by the best lawyers in America in the areas of ERISA and employee benefits law. In 2017, Jeff was named as the Lawyer of the Year in Minnesota by Best Lawyers in America. He is an emeritus member of the Great Lakes Area Tax Exempt Government Entities Council, and in 2016, he was inducted as a Fellow of the American College of Employee Benefits Council. He's a contributing blogger by the Stinson Leonard Street Benefits Notes blog covering new developments in benefits law. Jeff's an accomplished lawyer and CPA. I'm glad to consider him my friend. On the personal side, the only thing I hold against Jeff is that he's got an allegiance to a team that I just can't stand, which is the Green Bay Packers. So I'm a Vikings fan, but anyway, we'll accept him for that. But Jeff, you got an impressive background. Jeff's going to take you through the first part of our presentation, and then I'll cover the end of that. Thank you, Jeff.
Great. See if I can figure this out. Everybody hear me? Okay, great. Thank you, David. Thanks, everybody, for coming. The resume that David read, all it really means is I've been around a long time. Because if you wait long enough, you're in the business long enough, you're picking up some of those accolades. So, but it's been fun. What I'm going to do is cover kind of the overview of employee stock ownership plans, kind of from a high level viewpoint, you know, kind of where they fit in the realm of employee benefit plans, where they came from, what they are, how you might get to the point of looking at an ESOP. And then when David takes over for me, he's going to get into the nitty-gritty of how they work, how you might structure transactions, what are some of the pros and cons, and that sort of thing. So. This is the overview of what the topics that we're going to cover. We've got those. Works. So a number of you that we've invited to this program are business owners, and at some point during the lifetime of a business, you start pondering the question about how do I exit? What's my exit plan? Is there one? What are the opportunities? Do I have a succession plan? If I'm the top person or one of the top people in the organization, is there someone that can step in and take over for me and keep this company running and growing? So what are the alternatives? Well, there used to be a fourth one on this slide, which we don't see much of anymore, is going public. Mm-hmm. Although I should say last year I think there were a few companies here locally, Steve, is that right? A couple companies that did go public, but it's been a long time. For years we've been looking at more and more private equity companies, investors pooling their money and going out and buying privately owned companies and family owned businesses. So that's what we consider a financial buyer, okay? Private equity, somebody wants to make an investment, take out your ownership interest, and then they become the owner, they start calling the shots. The other one, again, if you've been in business, if you're in a leadership position, you may be getting calls, emails, letters on a regular basis from strategic buyers. A bigger public company that's in your same line of business wants to consolidate that industry, pull your company up into a big holding company. That's pretty common. I'm not sure how you handle them, those calls and letters when you get them. A lot of them are just kind of robo letters from business brokers looking for opportunities. But oftentimes competitors is what another strategic buyer. You're fighting it out in the marketplace for customers, and neither one of you can really grow the way you want to. So finally one comes after the other and says, well, I'm gonna buy you out so I can dominate in this market. So that's pretty common. There's different cultural aspects of the first two that I just described. You've got an employee workforce, you've got allegiances, an independent third party comes in and buys you, whether it's a competitor or whether it's a private equity group, you don't know. Sorry, Scott. You don't know what's going to happen to the leadership group, and are they going to change the benefits? Are they going to change the comp structure? Are they going to change the culture? A lot of questions. So in some cases that leads to companies, management ownership of the company looking internally and saying, well, maybe I'll just sell to my employees. And there's different ways of doing that, but the one we're talking about today is employee stock ownership plans. So when you're deciding on among those different alternatives, what are the considerations that come to mind? Sometimes some of our clients will hire an investment banking firm to help them get through the analysis and get through this question answer type approach. It's what do you willing to sell the company for? Okay, are you trying to maximize every last dollar from your investment in the company, or do you just want to get a fair price, fair market value? What's your tax position? Do you have operating losses that can shelter some of the gains, or are you trying to defer the gains on the sale of the business, that you might be interested in an installment type payout? What are you looking for in terms of consideration? Are you looking for a merger where you'd be happy just taking stock in a public company or stock in another company in exchange for your stock? Or are you willing, or you want cash, you want all cash today? Or would you be willing to consider helping the employees finance a part of that buyout, where you'd exchange your shares for promissory notes for exchange for the stock? I kind of mentioned the concept of legacy, and this is had a conversation at the beginning of the program. Is small town companies, corporations, employers are very important to that community, and there's a concern that if they sell to an outside buyer, they're not going to be, the ownership's going to be distant. They're not going to be as involved in the in the Chamber of Commerce and the local sports teams and all that sort of thing. and legacy. Some of these companies, privately owned companies, they have successive, family members that have grown through the business. Parents work there, sons and daughters work there, nieces and nephews. Other considerations: the personal retirement goals. Do you want to take cash in your chips and move to Boca Raton, or do you want to move to Texas or California, or do you just want to do a ramp down? You want to start taking some cash out of the business today, get some liquidity, but maybe work part of the year or so many days a week and still stay involved in management on the board. What is your retirement goal? And then the last point is how long are you willing to wait to close the sale on the business? If you want a quick sale, you sign up, somebody comes in, makes you an offer, you can close it within a matter of weeks if you wanted to. ESOPs, and you're going to hear about it a little bit more. ESOPs there's a process. There's a process to get the ESOP established and go through the fiduciary aspects of transferring the stock. So it is going to take a little while, so you have to plan for it. So, referred to ESOPs, as I kind of assumed everybody knew or had heard of ESOPs before, but for those who haven't, I'll just get into the real basics. What is an ESOP, Employee Stock Ownership Plan? It is what it says. It's a plan. It's an employee benefit plan. It's a retirement plan governed by ERISA, which includes regulated by the IRS, the U.S. Department of Labor. And to some extent, depending on how it's structured, occasionally you can get the Securities Exchange Commission involved if you've got employees trying to invest in the stock, which don't recommend it, but sometimes it happens. And then you'll hear us refer to ESOP trusts or ESOPs. Well, what is the difference? Well, the plan is a formal legal document. It's like an employment contract with the employees. Explains, just like your 401k plan, explains who's eligible, when do they vest, what are the contribution formulas, if there are any. So that's, it's like in your health plan document. It's a plan document that explains the benefit plan. The trust is a legal entity of itself that holds the legal ownership of the stock in the plan. And the same thing with your 401k plan. You have a trust in most cases, and the trust holds the mutual funds or whatever the stocks and bonds are that are in the trust. So what makes ESOPs different? They've been around since 1978, is that right? It's about shortly after ERISA was passed. They are different. They are a profit sharing plan, just like your 401k plan. They are a profit sharing plan. The only difference is, by statute, they are designed primarily to invest in qualified employer securities. So, employer securities of the sponsor of the plan, or in some cases, the parent holding company of the sponsor, stock in that company, both qualify as qualified employer securities. Non-ESOP plans are also allowed to hold employer securities by the code and the regulations, but there's a 10% limit on the assets that can be held in employer stock if it's not an ESOP. Okay. What also makes ESOPs unique are what we call diversification rates. So I'm an employee, I've been in the ESOP for 10 years, I'm over 55. If I'm a privately owned ESOP company, the ESOP has to allow me to sell some of those shares, even though I'm still employed, sell some of those shares, 25% for over a 5-year or a 4-year period, to diversify those shares into cash and other investments. ESOPs are profit-sharing plans, which means they're discretionary in terms of the contributions. So from year to year, employers can decide not to put money in the plan. Just like with a profit sharing plan, there's no minimum funding requirement like there is for defined benefit plans, pension plans, money purchase plans, that sort of thing. And the other unique aspect is the leverage. And David's going to give some examples of how leverage can be used to acquire stock without violating the prohibited transaction rules of ERISA. So do employees actually own the stock? Not really. They own the beneficial, the economic rights to the stock. There are certain voting rights that they're entitled to by law, but they're very limited. As I mentioned before, the trust is the legal owner, so the trustee, and sometimes the trustee can be one or more individuals that are inside the company. They can be individuals outside the company, or more and more frequently, an institutional trust company is brought in to serve in that role. In that role, the trustee actually has the voting rights to the shares, can elect the board of directors. So there's a give and take relationship between the boards and the trustee in terms of the governance of the company.
Jeff, a question.
Yep.
Do the employees have any real impact on corporate governance after you implement an ESOP? What's your perspective on that?
So, I don't know if everybody heard David's question. He said, do employees really have an impact on governance once you've put in an ESOP? My answer to that is it depends. Some closely held companies will, as long as the owner still has a majority position, will pretty much just leave it as an employee benefit plan, explain the plan to the employees, but not really involve them in the management of the plan. If the ESOP owns 100% of the company, that's a different situation. And when those situations, we see companies developing ESOP committees where they'll bring rank and file employees into the process to look at choosing the providers, looking at the plan design, helping to educate the other employees on the benefits of the ESOP. So.
Follow-on question: Do they vote for the members of the board of directors or not?
So David asked, do the employees vote for the members of the board of directors? I have two ESOP clients that actually do that, but they were not required to under the plan. They're not required to by law. So they just decided that they wanted to pass through those voting opportunities. But as a general rule, it's not required.
Another question, Jim?
Yes.
Sort of the inverse of that, assuming that it's a situation where the employees are not voting on the board members, they're effectively then a truly passive investor in an indirect beneficiary. Does that create liability for those on the board? Or do they have the same sort of protections that any other board and board officer would have?
Yeah, Scott's asking some questions about fiduciary liability of the administrators and the board members. I'm going to ask you to hold that because David's going to cover governance and fiduciary liability issues. So, thanks. We'll get back to it, guaranteed. So how you might not know anybody, or actually you may have neighbors, friends, relatives who actually participate in ESOP. You don't know it. Okay, so how many ESOPs are there? According to the National Center for Employee Ownership, there are over 11,000 ESOPs in place in the United States. These are a couple years old numbers, but I'm sure it's pretty close to where we are today, covering 10 million employees, and that's according to the NCO, that's 9% of the private sector workforce. Take out the government workers and the public companies, private sector. That's a big number.
Hey, Jeff, just on that number, we do some comparisons at our shop. There's about 4,000 publicly traded companies, so 11,000 ESOPs, 4,000 publicly traded companies, and it'd be about 9,800 private equity owned firms. So it's a big number compared to other ownership structures. Now, it might be the average size of a PE owned firm versus or public firm versus ESOP firm is probably lower, but would say it's growing too.
You might want to repeat that with the mic, just so we can hear.
4,000 ESOP, publicly traded companies.
4,000?
4,000 is the number we have in our chart.
Oh, that's interesting. The NCO number that I have here is 750 in publicly traded, so I don't know.
No, 4,000 total. So of the,
Oh, okay.
in terms of, I guess the point was, it's a pretty expansive ownership structure, ESOPs, even though you may not have heard as much about it.
I don't get a lot, yeah. They're not advertised in the paper every day. So how about here in Minnesota? David, you can talk about California, what your experience is there in other parts of the country, but Minnesota is kind of a hotbed for ESOPs. And Steve's firm is a great example of that. Chartwell, they ESOP companies since the 1980s have just blossomed. There's about 400 ESOP companies. I'm sure this number is old. It's probably higher than that today. But that's if you look at the statewide, that's a lot of companies that are have ESOP ownership. So what's the spread of ownership? Majority, minority, 100%. How does that break out? NCO says about a third of ESOPs are majority owners. That's where you get into some of the governance issues, where the employees, the ESOP itself actually controls what's going on in the company. Obviously, the remaining 2/3 are minority. In 1998, I think it was, Congress changed the law to allow S corporations to hold ESOP shares. And at that time, and we'll talk about the tax benefits related to that, more and more companies became 100% owned by ESOPs. So, but right now there's only about 1,500, which is about 14% of the ESOPs are, total ESOPs are 100% ownership. So I kind of alluded to this earlier. If you have an ESOP, does that mean you can't have any other retirement plan? Absolutely not. Most of the ESOPs I work with, companies also have a 401k plan. Some of them also have a pension plan. It gets a little tricky. We've got an administrator in the room here, because there are some testing issues that arise when you've got more than one qualified retirement plan, because there are limits that apply on an aggregate basis. But it's very, very common to have the 401k, which is viewed as more of a savings plan for the employees. You might have a matching contribution that goes with that, but the profit sharing component of those profit sharing 401k plans typically gets shifted over into the ESOP, because the ESOP is the discretionary plan. That's an employer funded plan. It's providing the benefit in the form of stock as opposed to mutual funds in the 401k plan. But very, very common to have both. We used to see combo plans, money purchase plans combined with ESOPs. I don't know if I've got, I don't think I have any left, because there was a law change in 2002 where you can accomplish the same thing with just a 401k and an ESOP, standalone. There are things called KSOPs out there where the employer decides for one reason or another they just want one plan. So they have the 401k trust, and that same trust also has the ESOP component to it. And there's separate record keeping, but it's all under one plan. We call those KSOPs. What I find more often, what tends to work better, just kind of keeping everything straight, is go out and get your bids on your 401k, because you have the more flexibility with the vendors as you go out to the market with 401k plans, because there's thousands and thousands of vendors that deal with 401k plans. There are not that many companies around the country that administer ESOPs. So if you go to some of the major brand, household name vendors, and you say, well, we have an ESOP, we have a KSOP, and we're a privately owned company, they're just gonna say, no, we're not interested in bidding on you. But if you split that plan, you have separate plans, yeah, they'd like to bid on your 401k. my experience. So what are the advantages? The tax advantages in the code vary depending on what the form of your entity is. Now, I don't know how many of you are structured as LLCs. We see more and more of our clients at Stinson structured as LLCs. Well, I have bad news. You can't qualify for an ESOP. LLC units do not qualify as qualified employer securities. There is at least one tech advice private letter ruling where the IRS allowed a company, an LLC, but only because they had elected under the tax code. There's a form election, you file a form, they elected to be taxed as a C corporation. So they said, well, the way under the choice of entity rules in the tax code, if you elect to be taxed as a C corporation, then we will treat you like a C corporation for all purposes, including ESOP. But those are pretty rare. I suppose an LLC can reincorporate or somehow restructure as a corporation if they really were interested in pursuing this. So what are the advantages if you are a C corporation? And you're going to hear more about this later. Some of you may be involved in real estate. You might be familiar with 1031 rollovers, where you can sell a piece of business property, and then within a certain period of time, as long as you reinvest those proceeds in other business property, you get a deferral on the gain. You have to change your basis a little bit, but you get a deferral. Well, there's something similar with ESOPs. So we're going to hear more about that later, but you have to be a C corporation to take advantage of that rollover capability. It involves selling your private company stock, rolling the proceeds over into qualified other securities. The other advantage for C corporations is you can deduct, in addition to taking your deduction for contributions and deductions to pay down the debt on ESOP debt, you can take a deduction for reasonable dividends under a section of the code. So it kind of juices up your ability to use the tax code to shelter income by making additional contributions to the tax deductible contributions to the ESOP. So what are the other savings? Pre-tax contributions go into the trust. What can the trustee do with those monies? Can pay off debt if they've got direct debt with the outside shareholders, or if they've got a loan from the company to buy stock, they can use that money to pay down that loan. The company can use the cash that recycles through for acquisitions. Again, on a tax-favored basis. There are limits, as I mentioned before, limits under the code in terms of how much you can contribute. C corporations have a special advantage. They can deduct 25% of the employee payroll up to the 401k compensation limits for employer contributions into the trust. And those contributions would be aggregated with any profit sharing or 401k match that the company decided to provide. But then under the special tax code provisions, if the ESOP borrowed to acquire the stock, the company can make additional contributions to cover that debt service. So it kind of is doubling up of the contribution limit. So what about S corporations? And again, seems like those clients of ours that aren't LLCs, they still like the pass-through concept, so they may be organized as an S corp. Most of the ESOPs I work with are operating in the form of an S corp. S corporations operate like partnerships. The income of the partnership, or the income of the S corporation passes through to the shareholders. And so typically the owners of the S corporations will take a certain amount as W-2 salary, and then the balance of their income will take as distributions or dividends coming through the S corp. Well, as I said before, since 1998, ESOPs have been allowed to hold S corporation stock, exception to the rule. So what's the advantage of that? Well, the ESOP trust, any qualified retirement plan trust is a tax exempt entity. So any earnings that get allocated inside of a qualified retirement plan are tax deferred. So the earnings on your 401k, the earnings on your mutual funds, the dividends, the capital gains, interest that your employees earn on those accounts, none of that's taxed until they take the money out as distributions. Quite powerful. But with an S corporation, particularly a closely held S corporation that goes 100% ESOP, it can become basically a foundation. Becomes completely tax exempt. All the earnings of the company that ordinarily was passing through on a K1 to the shareholders now that K1 gets issued to the ESOP trust. ESOP trust is a tax exempt taxpayer, no taxes are paid. So if you think about, think about it as an S corporation, how much of the taxes are distributed out, and a lot of times companies will only issue dividends to the shareholders to cover the tax liability, and those are big numbers. Just think of what would happen if you didn't have those distributions. You weren't paying those monies into the government. Well, that money stays in the corporation and is available for bonuses, acquisitions, mergers, all kinds of things the company can do with it. Redemption of stock, if it's not 100% ownership already. Pretty powerful. Question.
How does that work if it's not 100%?
The question is, how does it work when it's not 100% ESOP? Well, right now, you're an S Corp, say you got 4 shareholders, each get a K1. Now you've got 3 shareholders and an ESOP. You still get 4 K1s, but the ESOP's going to get whatever is pro rata shares of the earnings will get allocated to the ESOP, no tax due. The other shareholders that are still private taxpayers, they'll still have to pay taxes. So you got to make sure if you're doing distributions to cover the taxes, you got to do pro rata. So the ESOP's going to have cash, which the ESOP's going to need anyway, because you have to have cash in the trust at some point to cover distributions to employees when they leave. Okay. Good question.
Another question, just so I understand the terminology. 100% is a situation where all the equity of all owners has been converted to ESOP equity?
Yes. Yeah. 100% of ESOP means all of the common voting stock is owned in the ESOP. And there are, what I see with most ESOP companies that go 100%, to replace that ownership, individual ownership for your key management group, is we put in things like stock appreciation rates, phantom stock, equity type incentives to accomplish the same type of reward and buy into the business, because you can't make it up right away in the ESOP or direct it like you want to do. Mike.
I'm stuck on the last sentence. I'm embarrassed to say that, but I'm stuck on the last sentence. It is taxed someday, right?
Yes. Well, this is just comparing the deduction for C corporations, the ability to deduct the dividend when it goes into the ESOP.
Oh, I see.
Compared to the S corp, you don't get that deduction, but it doesn't really matter because it's not taxed anyway. So it's the same amount of cash. You end up with the same net amount of cash in both the C corp and the S ESOP. But good question as well. So what other tax benefits or other advantages? S and C. Cash flow, I explained that. You just think about the monies that go to taxes, whether it's at a C corp or taxes that flow to the owners that go in. That cash flow becomes available. Another advantage, the tax rules allow contributions, non-cash contributions, to be made to an ESOP trust. Company can contribute shares, and those shares have a fair market value that Chartwell and their colleagues are going to determine what that fair value is, and the IRS gives the company a full particularly C Corp, a full income tax deduction for the value of the stock, even though there's no cash going into that plan initially. Now, ultimately, when the employees are entitled to a distribution, those shares will have to be converted to cash, and the company will have to find a way to get cash in the trust to pay that distribution. But for the time being, a company that has significant earnings can make in-kind contributions of stock and get tax deductions, which relates to cash flow.
Doesn't that dilute the share value of the
Yes.
ESOP ownership?
Yeah. His question was, doesn't that dilute the ownership? The answer is yes. It is dilutive. But the company still retains the cash. Instead of putting cash in, you put it in stock. So the company should balance out. And we'll let Steve kind of answer how that works with what the impact on value is of stock contribution. Okay. So what's the advantage to employees? Well, it's if you communicate the existence of an ESOP to the employee population effectively, employees will buy into it. A number of the members of the Minnesota ESOP Association have won national awards for their communication campaigns. Some companies, particularly ones here in Minnesota, excuse me, they communicate the employee ownership every day. New employees, old employees, customers, suppliers, they wear hats that say employee ownership, their stationery says employee ownership, their business cards say employee ownership. And that creates esprit de corps among the employees that really results in better financial performance. And they have the numbers to prove that. They've done studies of comparable ESOP companies, employee-owned companies, and their competitors that are closely held, and they're able to show that the employee-owned companies outperform on average, nationwide. So who's a good candidate? How am I doing time-wise here, by the way? Okay. Looking at the seller characteristics. A seller who wants to get a fair price for their stock, because under the regulatory rules, the price that the ESOP pays cannot be more than what an independent party determines to be fair market value. You usually get an appraiser, valuation expert to come in and give a fairness opinion on the value of the stock that's being sold. If you as an owner say, I want to get every penny out of this business that I can, I've worked hard for this, an ESOP is probably not the best solution for you. There's other considerations. A strategic buyer is going to overpay. If for some reason you're a competitor and you want that business out of your way, you'll do the financial analysis. You come up with fair value, but you'll probably pay a premium to acquire that company just to get them out of the market. The owner is someone who has all the eggs in a basket. They've got 90% of their personal wealth is tied up in the stock of this private company with no public market. They just say, I'm not ready to exit completely, but I want to get some liquidity. I want to diversify. My estate planning attorney is telling me I need to diversify my holdings. So I'd like to cash in some of that stock, put it in other investments, and start transferring some of that ownership over to the employees. With the potential rollover, that's another way to diversify and not get hit with a tax hit right away if you've got a lot of increase in value over time. With the 1042 rollover, again, which you're going to hear more about. And if you want, and I've had clients that have set up ESOPs and they just said, I want my employees to benefit. They worked hard. I want them to benefit. I want them to own this company. And that's the kind of mindset you need to have if you're a selling candidate. So again, what does the company have to look like to be a good candidate for an ESOP? Well, if it's going to use leverage, and most of the ESOP transactions that we deal with require some amount of debt to accomplish this ESOP sale. Well, the company has to be in a solid position to be able to service that debt. And you have to be cognizant of your other loans that you might have out there. You might have a line of credit, you might have term loans, mortgage loans outstanding. You have to be cognizant of those. Loan covenants to make sure that any loan obligations the company is taking on in connection with the ESOP is not going to put you out of compliance with those other debt obligations. So what the advisors will do on an ESOP transaction before all the parties will sign off as saying this is a go, this is fair, this is legal. They'll work with the financial folks at the company and develop projections and look at the cash flows. Here's the price that's being proposed. Here's the amount of cash available. Here's the debt, and here's the terms of the debt. Here's the expected loan payments that are going to be required. Does the company going to have enough cash flow after the conversion to the ESOP to cover those debt payments? If not, then you got to go back to square one and come up with a different structure. And then we've had, from time to time, we get companies that are, in this kind of a slide, in terms of their profitability, their business isn't growing, not a good candidate for an ESOP.
What about companies that kind of follow the markets?
Yeah, the question is, what about companies that fluctuate with the markets? We all have those, right, Steve, David? We all have those clients that go through cycles, business cycles, and that's where you want to build your loan obligations. You want to build your contribution requirements to be flexible enough to accommodate those downturns. The good news, good and bad news, is if you remember back in 2009, 2010, when we had a recession, a lot of the companies had to lay people off. And if you can put in a provision in your plan, in order to get an allocation for that year, you have to be employed on the last day of the year. Well, if your workforce goes down, your contributions will likewise go down. You kind of flow with it. As your hiring goes up, profitability goes up, you've got more funds available to provide those benefits. But it's a good question. I mean, there's very few companies, I think, that are immune. Maybe the energy companies are immune to the fluctuations of the economy.
Jeff?
Yep.
You mentioned that you want the selling shareholder may want to diversify his investments or investments. Can the ESOP trust diversify its holdings, or does it have to own employer stock?
Yeah. If everybody heard Steve's question, he says, can the ESOP be diversified? And the answer is absolutely yes. The Department of Labor has never totally explained what is meant by primarily. But if the Webster's definition, I think, means more than half. So those of us practitioners, we believe that as long as the ESOP owns over 50% of the stock, it can have other investments. And it's probably prudent to have other investments because, like I said before, you have an obligation under the plan to pay off the employees as they become eligible for distributions. They die, become disabled, they terminate their employment, they retire. Those are all trigger events where you've got to convert their shares to cash. So you want to have cash available in the trust to do it. If you don't have it in the trust, then it becomes a statutory obligation of the corporation to buy back that stock. But good question.
Question on that previous slide, if I may. Two questions.
This one?
Yeah, one is, can you define what this ESOP acquisition debt?
ESOP acquisition debt, that is a loan that's entered into either between the ESOP and an outside seller. It can be debt from a bank, or it can be debt from the sponsoring employer the proceeds which are used by the ESOP to buy stock.
Okay, and then my second question is on the C Corp scenario, you said there was some cap of 25% that could be retired by ESOP owner annually, I believe?
Oh, right, on the diversification. Well, it's any participant in the plan, when a mature ESOP, after age 55 and 10 years, you have to have an ability to cash out 25% at the employee's election. They can elect to diversify up to 25% of their holdings in stock.
But that cap wouldn't apply if there was a retirement or some other triggering event? It could be 100%?
Right, yeah. Yeah, although I don't think we have a slide on the distribution rules, David, but the statutory rules say that for ESOP, for the company stock portion of the participant's account, the most you can make someone wait is 5 years. I think it is 5 years after they terminate. And then you have to pay them out at least 20% a year for another 5 years. So it can be a 10-year payout. I don't have many companies left that are still doing it that way, that they don't want employees still in the stock for that 5-year period, because a lot of when the stock's increasing, you've got employees that are benefiting from that are no longer involved in the company. But from a cash flow standpoint, the flexibility with the ESOP is it's very flexible in terms of the having enough cash to pay people out. Yep.
Our experience on that, Jeff, is that when people depart for not death, disability, normal retirement, then normally the company has the wherewithal to stretch out payments to them to make it easier on the corporation. But when they hit retirement or death or disability, normally I don't know, Dave or Jeff can weigh in, normally they pay those people out a little quicker. I mean, anyway.
It depends upon the cash flow of the company, the economics of the company, what the price of the stock is, the valuation. But many of our ESOP clients, and I would say our meaning all of the people who are the presenters today, when you have a company that's doing generally well and its stock, its profits are appreciated and its value is appreciated, it makes sense to cash those people out as quick as you can, subject to cash, because otherwise what you're doing is you've got long-term employees who are basically sharing their appreciation with people who left the company. So that's the sentiment, and usually the way it works is cash them out as quick as you can, subject to cash availability and profitability.
Yeah,
And it is, just to be clear, it's the end of the 6th plan year following the plan year in which you terminate, so it's almost 7 years after someone leaves, and then another 5 years, 6 installments over 5 years. So really, it's almost a 12-plus year period. And for companies that don't have the profitability and they're in a tight squeeze, it's the Great Recession or some kind of recession is happening. Our clients have used that capability all the time because they have to defer it. And I would recommend looking at distributions each year. ESOPs are the only benefit plan that's got a specific provision in the law, 411D6C, that basically allows you to slow down the distribution process if you run into trouble.
Conversely, if during that payout period, the value goes up, the payout would go up?
Yes.
Okay. So
That's the scenario
it's
I was
based-
talking about.
It's based on 20% of the market value at that point, as determined by that third party.
Right.
Okay.
Right. So a couple more slides, and I'm going to turn it over to David. What kind of company? What's the profile? Additional profile factors for ESOP companies? We talked about paying off the debt, because typically there's going to be debt and the cash flow aspects of that. Because the limit is based on a percentage of payroll, I've had a number of companies come in saying, well, I want to do an ESOP, and they've only got 10 employees. And you can only count compensation up to $280,000 for any one of them, those employees. Your payroll base gets very small. 25% of that number can be very small. So if you're a C corporation, you can make it work, in the 15 to 20 range. My experience with S corporations, because of some additional complexity involved with S corporations, it seems to me if you have to have at least 30 employees, is what my experience has been as an S corporation to do an ESOP. Maybe you've done some smaller ones, David, but we run into problems. I just want to talk for a second here about management depth, and established plan for succession. When you meet with the Steve Nelsons of the world, the valuation folks, one of the first questions they're going to ask you as a business owner is, okay, you want to sell to the employees, and you want to retire. Who's going to run the company? And are those people? Have those people been trained? Have they been transitioned? Have they been given authority? Who are they? And it will impact how an outside buyer, including the trustee of an ESOP, will look at the value of your company. So one of the first steps before you look into an ESOP might be, what's your succession plan? And if you don't have anybody in place, we know folks that recruit people to come in and manage ESOP companies that have been in financial roles, have been in management roles. And there are specialty recruiting firms that will find people that have that experience and can come in and get your succession plan in place. And then back to some of the earlier questions, you have to be, even though they may not have legal rights to be involved in the business, employees will start paying more attention to what the board is doing, what management is doing, because everything impacts the financial aspects of the business and ultimately the value of the stock. So they do occasionally, or they do quite often, start acting like owners and wanting to know more, and kind of paying attention to what's happening. So you have to be in an environment where you as a management are not offended by employees making inquiries about what's going on. And I think with that, so you've looked through all these factors and you decide you want to do an ESOP. What is it really going to look like? How is it going to work? And I'm going to turn it over to David Johansson. You're going to introduce yourself, right?
Yeah, I will.
All right, thanks.
Good job. Great job, Jeff. We got to do this more often together because it's a good combination. Typically, I've done that same bit, and it's nice to have Jeff helping out with the heavy lifting here before I get started talking. And we save all the tough stuff for the guys at the end, too, because Nellie's going to deal with valuation, which is at the crux of any. You don't even get past square one if you don't get a preliminary valuation that makes sense to the owner. So you got to, and you can't do that in a way that's not fair and is going to exceed fair market value. So it'll be interesting to have Nellie talk about that. And Mike has been in his specialty forever, helping our clients and many other clients walk through the whole process of trying to defer your taxes on the gain of a sale. So it's an exciting, and there's some exciting opportunities there as well. I'm Dave Johansson. I have been doing this for about, I started out with somebody known as the king of ESOPs in Minnesota. He was in St. Paul. His name was Dennis Bowman, and he was the self-proclaimed king of ESOPs. So I got trained by him. I then went out to the West. I went to the East Coast for a while, then went out to the West Coast, and Ron Ludwig was my mentor in the ESOP business. Ron was one of the most prolific ESOP attorneys around. Learned from him, learned from Jeff along the way many times. And I've been fortunate enough to work on over probably, I would say, close to 700 or 800 ESOPs in the last 35 years. And they're not a panacea. They're not perfect. I've seen the dark, in 35 years, I've seen the dark underbelly of ESOPs, and I've seen lots of great companies. I mean, Nellie and I work on one company that's not a huge company in Northern California that's probably each year on average distributed $500,000, $600,000, $700,000 of ESOP benefits during my 26-year involvement in the company, and that's small potatoes to someone like Cargill or Medtronic. But you know, that's the kind of ESOPs that happen all over the country, and we're proud to be involved in them, and that's what you can accomplish. But you got to go in smart at the beginning and do the planning that's necessary, starting with the valuation and the feasibility, and making sure, I think the key is make sure that you've got a situation in which you want to share equity with your employees and you want to get them involved in helping you grow the business. If you've got a real tight leadership and a lack of understanding of sharing equity and sharing financial information with your employees, then I don't think an ESOP's a good thing for you to think about. You got to create that participative environment in order to succeed. Jeff left me with the great topic here. Poor candidates for ESOPs. I mean, it just makes sense. If you're going to go forward with an ESOP transaction, and most ESOP transactions involve some form of leverage, and that means that either you're going to have the seller extend credit to the ESOP, or you're going to have the ESOP borrow money from the corporation, and that's debt. And so you know, if you got flat or declining earnings, you're probably, you know, when you go out and buy your house, you know, you incur a mortgage, you want to make sure that you got enough profitability and salary to pay back the debt you incur to buy the company, so that eventually the employees can have a mortgage burning party and share in some of the equity of the business. So that clearly is not a good candidate for an ESOP. I don't know how the clicker works here. To the right. To the right? Oops, too fast. How's the arrow? Is there an arrow on here somewhere? Down here? Oh, the other way. Okay. Jeff already talked about lack of depth in the management team. And then the other thing that I don't think we've talked about yet is a lot of times you have a management team that wants to buy, but they don't have the financial wherewithal to buy the company. So then you've got that issue of, you know, they want targeted equity incentives. They want to get some value. How do you deal with that? And I think I would say if they get turned down and then the owner sells to the ESOP, there's going to be some resentment there. So I think it's important with all ESOP companies for you to think about sharing equity with a targeted group of management employees too, because they're going to want to get more than just their pro rata share of the entire pie. That's the people who help you run your business on a day-to-day. So I strongly encourage you to look into equity incentives directed to the management team in addition to a broad-based employee ownership structure. So what do you do with this interesting device known as an ESOP? Jeff did a great job of giving the background, but now what are the practical ways that we can use the ESOP? So that's what I'm going to talk about for a few minutes now. The first thing that you can do is you can create a non-leveraged ESOP, and Jeff mentioned a little bit about this. So what a lot of our companies that we've worked with have done is they've created an ESOP and then either started to fund it over a period of years with cash contributions that they can deduct on their corporate tax return and build up a fund, so to speak, within the ESOP that can be used down the road as a cash down payment to the selling shareholders. So we've had a lot of ESOPs funded that way that are basically set up with basically a sinking fund of cash, tax deductible cash that's used down the road to provide the down payment to the selling shareholders so that the selling shareholder can take that cash and then use the cash to buy the stocks and bonds that Mike's going to talk about later. The other thing that you can do, if you don't have the cash to put in the ESOP, we've had a lot of companies, and one of them actually is SAIC. I think someone said here that they've worked with the Beister Institute, and the founder of the Beister Institute created an ESOP for an employee-owned company out of SAIC many years ago, and they talked about how at the start you had this company, the owner had 100% of it, and he and his family started to give away pieces of that company. they took tax deductions for those, the sharing of equity with the employees. And Corey Rosen, my friend, who's the founder of the National Center for Employee Ownership, talked about how, over time, they gave away that stock, but then they retained some, and they built a multi-billion-dollar enterprise. And so they might have had 10, 15, 20% of the company at the end, but that was worth tremendously more than what they had at the start. So they got that by sharing equity and not necessarily taking cash off the table. So that's another way to deal with a non-leveraged ESOP. So you either make tax deductible, I can't get the pointer to work here, but you either make, under number one there, you make tax deductible cash or stock contributions to the ESOP. The ESOP can later on use those cash contributions with leverage, with either seller debt or other debt, to buy stock from the founding shareholders. And then what happens is under 3, you allocate the stock out on a pro rata basis to the employees. So if I earn, let's say we have $1 million of annual compensation, and I earn $50,000, and I'm one of the ESOP participants, then I would get 5% of that stock or cash allocated to my account. If it's cash, then the cash would be used to buy stock ultimately, and you just replace the cash with the stock, and I'd have that equity ownership in the business. So it's a simple way to create value transfer from the founding shareholders to the employees. And it doesn't have to be leveraged, doesn't have to be high debt responsibility or anything like that. Yeah, Scott?
So that pro rata ownership or participation is pro rata based upon direct on compensation?
Yes.
Is it all forms of cash compensation?
It depends. It's typically defined as cash compensation, bonuses, and that type of compensation, but you can define it. It gets complicated because it's got to be a non-discriminatory definition of compensation. You can't create something where it benefits highly compensated employees, so you can include other forms of comp, but it's not typical. It's typically just cash and in the way of annual compensation or bonuses, but you can get creative if you need to, and we do. Just got to be careful that's not unfair to the non-highly comps. Yeah. There's this bad word called highly compensated employees in the statute. It's great how the IRS creates these great names for bad things, and then they pick on the highly compensated employees. So you just got to be careful. But a lot of ability to be creative. Down the road, at the end of the day with the ESOP, where do you get something for the employees? Because it's great to have equity, but then how do I convert that equity to cash and use it for my family? And again, I'd point that out too. I personally like an ESOP that finds a way to create some cash for the employees as the years go by, because a lot of people live on getting cash to pay for things like mortgages, sending kids off to college, and other things. So I think it's important not just to simply rely upon the ESOP as a means to create equity, because it's great if I've got $300,000 in my ESOP account, but if I can't pay my mortgage or send the kids to college or go on a vacation or things like that. So I think it's important to create some kind of performance plan with your employees that gives current cash compensation as well as equity compensation, or you're gonna fail ultimately in your whole approach to this, or you won't succeed as much as you could. So what happens when you leave? Jeff and I already talked about it a little bit. You distribute the stock to the employees under 4 there, and then they have a right to put that stock back to the corporation or sell it back to the corporation. Then some crazy guy like Nellie here goes ahead and tells you how much it's worth, right, Steve? And then you cash them out, and typically that can occur with some of our clients, it occurs in a cash lump sum down payment or lump sum payment because company's value is increasing like this and they want to buy the stock back at a lower price. A lot of times it's done over the stage period that we talked about earlier with the questions that you asked. But it's an important process to keep in mind. And I think, Steve, you folks at Chartwell do some ESOP repurchase obligation studies, correct?
We do.
You want to talk just for a minute about that, if you
Yeah.
don't mind?
Yeah, so kind of what David's referring to is, you look at these repurchase obligation studies, and there's a certain census in the company and in the greater community of that employer, and you say, well, more times than not, I'll tell you this: an ESOP was set up, and they have a group of employees, management level, maybe 45 to 50 years old. Seller is 60 to 65, sells. Everything works good until that group of employees now want to retire. Now, two things happen there. We have to replace talent to run the company. Oh yeah, and we got to buy out their ESOP accounts. They were highly compensated, so they have the biggest accounts. And so it creates a challenge, a cash challenge, operational challenge for the company. And so I think David alluded to it, Jeff alluded to it. Planning is key to avoid that situation. We've learned over time, attorneys have learned over time how to avoid that problem 7 years out when you're setting it up today. So is that kind of what you want me to hit there? Yeah.
And I think we've seen in the DOL investigations and the DOL investigations of ESOP transactions, they've looked at that and they've said they want to see that the fiduciaries are hiring somebody like Steve to run an ESOP repurchase obligation study before you start to make sure that the thing is feasible. Because it may not be feasible, right, Steve?
That's exactly right.
To fund that debt.
If you have the wrong demographics, my little example there,
Yeah.
it's possible that an ESOP's not going to work.
It might not work. Yes, sir.
So I'll ask this question before I forget to ask it later. With respect to the DOL investigations, what's the
My favorite subject, by the way. Just kidding. That's why I stepped closer to you.
what has for a while it seemed like investigations were trending upward. Now we've got a shift in leadership in the executive branch of the federal government. Has that affected or had any impact on the trend of those investigations?
Good question, and I'll just restate it so everybody can hear. And the question is, there's been a change of administration. There was a thought that maybe the prior, that isn't your question, but I'm kind of hypothetical. Yeah, I'm going along that line, that the prior administrations had a focus on investigating ESOPs through the DOL and had the people in that organization that were focused on making sure that the owners weren't really getting too much out of these ESOPs and they were really benefiting employees as a whole. So the question is, has it changed much? I will tell you that half of my business is defending ESOP fiduciaries and directors and officers and selling shareholders in litigation. I unfortunately have the first case. I didn't do the ESOP, but I have the first case that was brought under the Acosta Secretary of State who was appointed, or Secretary of Labor who was appointed by Trump. And that case was filed in Hawaii. And so we really, in my opinion, it hasn't really changed much. And I'm saying, now I'm looking at 35 years, okay? I think the administrations change, but the people that are at the DOL have had, in my opinion, a bias against ESOPs because they think they're just devices that are used to line the pockets of highly, people who own companies. And they don't see all the great things that we see. So I really don't, my opinion is I don't think it's changed dramatically. I think the emphasis is still there. I will say that I've seen a lot of positive activity at the ESOP Association level, and it's an organization that you should join if you're going to have an ESOP. I've been a member since the 80s. There's been a lot of positive activity where representatives from both the Democratic side and the Republican side have gotten together and have put a lot more pressure on the DOL to not just investigate so many ESOPs. So hopefully, it will get better with that, but over 35 years in this industry, I've seen an institutional bias against ESOPs at the Department of Labor. It's just the way it is, and it's unfortunate because I personally have been involved in creating over $1 billion worth of retirement benefits through ESOPs, through implementing ESOPs, and I think they're a great device, and I think that institutional bias is not right. That's just my personal opinion. Unfortunately, I haven't seen it change much. Great question. So I'll jump on. Now, what about a leveraged ESOP? Leveraged ESOP is fun. We got a private equity guy here in Scott, so we can talk about leverage, right, Scott? Leverage is simply just another word for borrowing. And most ESOPs that I've been involved in my professional career have had some form of leverage because most companies don't have enough cash on their books to basically fund a buyout in one fell swoop. You got to do it over time. So what happens is you go out and you see the bank there, and number one, you either go to the bank, and if you've got a company with hard assets, things like plant, equipment, land, other things that you can leverage against, you might get a loan. Or if you're a big enough company that's got enough value and equity and profitability, you might be able to go to a large bank and or a private equity house and get the funds to basically loan that to the ESOP in the beginning, have the ESOP use that cash to buy out the selling shareholders, and it happens like that. And then over a period of time, what happens is, there's a really complicated chart, but over a period of time, the corporation earns profits. It makes cash deductible contributions to the ESOP trust. The ESOP trust uses that to repay the debt that's incurred with the company. That's all tax deductible to the company within certain limits. And then the bank and or mezzanine lender gets repaid from that money as well. So it's a great way of creating equity ownership. And what happens is, over time, as you pay off that debt, as you make contributions to the ESOP trust, and it's used to repay the ESOP debt, that stock is released to employees in the same way that it described earlier. If I have 5% of the compensation base of the entire employees who are participants in the plan, I would get 5% of that stock allocated to my account each year as we release, so that we create a release formula. We release shares from the suspense account, and then we allocate them out to participants. And it's those kinds of ESOPs. I've mentioned Medtronic. My friend Bruce Grussing was an attorney at Great Plant, and he was one of my mentors along my career. And Bruce worked on Medtronic ESOP, and Anderson Windows is another one. But those types of ESOPs, because of the leverage that they were using and the relatively low numbers of employees relative to the value of the company, resulted in contributions and allocations to participants' accounts, sometimes in excess of 100% of their salary each year. I mean, they were just incredible. So you can have some substantial benefits there, because you get not only the cash contributions, you also get dividends that are used above and beyond the cash contributions based upon compensation. And then guess what else you have? Value appreciation. You get all three of those, and all of a sudden you got a great experiment with an ESOP.
And the interest.
And the interest, yeah, exactly. So anyway, other than that leveraged ESOP is typically the typical model for accomplishing an employee buyout with an ESOP in this country, and has been for my whole almost four-decade career in ESOPs. It's a great model, but make sure you go in and you create the feasibility study at the start to make sure that you know that you can actually pay back the debt that's incurred to buy the stock in the first place. It's really critical. Everything else works kind of the same way there. The one thing I wanted to point out with one of those transactions, the leverage transactions, almost all of the deals of the smaller, closely held companies, and I'm not talking about companies that aren't worth anything, I'm just talking about companies that might be middle market, what we call middle market, and typically they're companies with $5 to $15, $20 million of value. A lot of those transactions happen as essentially seller finance transactions, because we can't get private equity interested in us because we're not big enough. We can't get large banks interested in loaning us a bunch of money because we don't have real hard collateral. Our collateral walks out the door every day with the people that run our business. So typically you don't get, typically you have seller finance transactions. So what we do is we go through that same model I talked about, but at the end of the day, it's simply the employees through the ESOP trust issuing an IOU to the family or the founding shareholders, and then the company making profits, putting the profits into the ESOP then paying the profits back to the company, and then the company taking a portion of those profits and paying off the debt to the selling shareholder. Still get the tax deferral that Mike's going to talk about, and I'm going to put one twist on Mike's subject before he gets into it. He's going to do a great job. And by the way, I've worked with Mike and his company for over 2 decades, and they're the most professional investment advisors I've worked with, because they go in always trying to find the right way to achieve the client's objectives. And it's hard for us attorneys to give up the baby after we get done, but you give it up to people like Mike, who then do the analysis to help the family and the selling shareholders defer their taxes properly. But this is really critical. I also mentioned warrants here. I know that Scott knows about warrants, but probably not many of you have heard that topic. If you're going to give seller financing, if I'm the seller and I'm going to extend a loan to the ESOP effectively for 10 or 15 years, I should get something in return for that. And that is typically not just interest, but I should get, because the ESOP doesn't have the assets to go out and get bank financing, so why not give the founding shareholders a little additional benefit known as warrants? And they're typically like stock options. They're low-priced ways to buy a piece of the company back and then sell it to the company and create some reward to the founding shareholders for funding the ESOP buyout over a period of 10 or 15 years. There, you need to get someone like Nellie involved, have him issue a fairness opinion that says that those warrants are fair to the ESOP from a financial point of view, because you don't want to be too fair. That's where the gentleman raised the question about the DOL. That's where you start telling the DOL, we are just being favorable to the selling shareholders, and there's a balance. But someone like Nellie can evaluate. Go ahead, Nellie.
I was just going to say, I put a little different spin on
Yeah, go ahead, Nellie.
Yeah. Play. So if you do a $10 million ESOP transaction, there's some bankers in the room. We go to the bankers and they say, well, we'll give you $5 million. So now you got $5 million gap in your purchase price. How are you going to, bridge that gap? And maybe there's mezzanine financing, and maybe it's too costly. But the owners can provide that seller financing, that extra $5 million. Now they're subordinate to the bank, and for that position in the capital stack, they should get an extra return. So maybe they should get 12%. Well, if we pay them 12% cash interest, we're never going to get out of our leveraged position. The senior lender probably won't allow us to pay 12%. So the other way to get there is say, well, we'll pay you 3% cash interest, and then we'll get you that other 9% through this warrant feature, which ebbs and flows with the value of the stock. And the owners usually take a liking to that because they know the investment. They've lived it for 20 years. They like being invested in their own company. And the bankers like it because then all the money is getting funneled toward the senior. Pay them off, then you go pay off the seller note the warrant, and usually it's a pretty good deal.
And the word to the wise here is Nellie does that typically, and most valuation companies do that typically for the ESOP. They're looking at this, is it fair to the ESOP? The selling shareholders, unfortunately, probably need to go out and hire their own financial advisor to help them figure out what that is, and then you might have a dialogue between the ESOP fiduciary, the trustee, someone like Mr. Nelson working on behalf of the ESOP, and maybe the financial advisor for the family to create something that's fair to everybody.
I think it's just great that the owners understand the options.
Yes.
Right, if you don't want that seller note, or if you want way more warrants than we think on the trust side are reasonable, then only sell $5 million. And then we'll buy another $5 million 3 years down the line. There are ways around, to get through that. But anyway, another question.
Yeah.
Well, are there objective standards that would apply to a warrant or other transaction expenses associated with a subordinate loan? So another could be just a loan initiation fee. Or is it purely fairness? And if that's the case, part B of that question would be, fairness as compared to what? Are you doing a market analysis for subordinate debt in a particular industry, or?
Really good.
Good, great question. Go ahead, Nellie.
So we are comparing that, attempting to comparing that security to another market security with similar characteristics. And usually we start building up from, mezzanine financing, and mezzanine financing that takes out a certain portion of the enterprise value or a certain turn on EBITDA, things like that. So you're trying to get like securities, and what are they priced at? And there are different ways in warrants. Like you talked about that initiation fee and exit fee, right? I mean, there are different ways to skin that cat.
And Nell, what's happened, Scott, on that is there's been case law that's developed how that's fair to the ESOP, and there's been cases where they design a security and they sell it to management for X, and then they sell it to the ESOP for Y, and there's a big delta between the two, so that's the place you want to stay out of, because that's a loser. And then you got the DOL at your door, and you got problems.
So is it a total, is the fairness that you're talking about then, if there are not purely objective kind of just standards to apply, is the fairness then considering everything in total? So if I have a package that gives me 5% annualized return or coupon or interest, but I got a 5% initiation fee and 3% on exit, and I've got a warrant package, is it the total package of consideration?
Oh, yeah.
All
And all
Relative fair.
And, for example, let's say that the selling shareholder decides to stay in as the president of the company, and they've got compensation, benefits, perks, bonuses, all of that, I think, goes into the equation to make sure that it's fair.
Now, David, you talked about, because you represent owners.
Well, let's be clear. I typically represent companies who are ultimately owned by somebody who then sell to an ESOP. Yes, difference.
Not all owners are looking for the last dollar.
Yes.
But to David's point, they should know what is available. They may say, hey, we could do this, we could get you 25% warrants, that would be reasonable. Hartwell would sign off on that. They may say, you know what? Just give me 8% coupon, I'm good. That happens more times than you would expect. That, they sold the company for $20 million. They never thought they were going to ever have $20 million.
But when you do that, make sure that if you're wearing the fiduciary hat, you're talking to someone like Nelson, and you're documenting what you do to represent the best interests of the ESOP, so that when the DOL does come knocking, and they'll investigate almost every ESOP at some point, have a written record of what you did to represent the interests that you were working on. That's why I like to have financial and legal advisors on the selling shareholder side to just help balance that out and have them negotiate directly with the ESOP advisory team. I'm over already, but because you guys listened to me, we actually had an active participation, and that's what I wanted to do. But I've got two other topics after this question.
I just have one more question on the seller financing. Can you make the seller a secured lender? I know he'd be subordinate to the bank, but can they take security in the assets of the company?
They can take security in the assets of the company, the seller can, but you got to be really careful here, because the ESOP can only give as collateral the stock of the company and the company's guarantee of the debt and the company's commitment to provide cash contributions to the ESOP.
I'm talking about if the selling shareholder sells to
I
a
understand. And what I was saying was, yes, you can give special collateral to the selling shareholders to secure this, but you got to be careful, because the DOL and their regulations have certain limits on what the ESOP can pledge, and so you can't mix the two. You got to be careful not to, by doing what you're talking about, if I gave a special allocation of collateral to the selling shareholders, the DOL may look at that as a prohibited transaction. So you just have to be really, it's not a black and white answer, and it's really based upon what you're looking at giving as collateral and how the deal is structured. But great question, and something you can do. I mean, if you have assets, the seller can take a position in that collateral. The ESOP just can't be involved in supporting that. I'm going to cover two other topics and then get it on to Nelson here, Mr. Nelson. By the way, on this one, Mike's going to cover tax-deferred investments and that whole strategy. All I ask, Mike, is if when you cover it, you could cover the idea of investing in a company that the founding family owns after the deal closes, because a lot of founders have liked to do that rather than go into the market and invest in stocks and bonds of U.S. companies. So Mike will cover that. I had wanted to, but I'm going to punt that to him. And then I wanted to get, so that whole, and by the way, if you need, Jeff and I can get you this PowerPoint. So if you've taken pictures or you want to get it, just ask one of us and we'll email it to you. No propriety there. This just talks some more about what we've already been talking about. I wanted to talk quickly about board of corporate governance and then end with the players, and then Steve Nelson will come up and talk about valuation. I was asking Jeff these questions earlier just to start to get it talked about. And Scott, if we haven't answered your question, we can cover that here. But basically, it's an interesting corporate governance model when you've got an ESOP, because a lot of the ESOPs we work on ultimately become either majority owned or 100% owned by the ESOP through an ESOP trust. So then what we create is we create a circular structure. We have an institutional trustee or a board of trustees that operates to elect the board of directors of the company. And then that board of directors of the company is also the entity that appoints the institutional trustee or the board of trustees to manage the fiduciary responsibilities under the ESOP. So if you're more than 50% or you're 100%, you've got a circular corporate governance structure. I've never seen really a fight in 35 to 40 years of doing this, so I've never seen a shootout, a Texas shootout as we call it. It is important, though, that you create on your board of directors, create a nominating committee, so that nominating committee can, and include on the nominating committee some outside independent directors, so that those independent people can vet the candidates who are going to be potentially either institutional trustee or a board of trustees, so that you've got some monitoring of who those fiduciaries are on an annual basis. If you don't do that, I think that's a mistake, and that's an easy way to deal with this circular type corporate governance. If you've got true outsiders on the board of directors vetting the candidates who are ESOP trustees or board of trustees or institutional trustees, it's a great way of making sure that the process is done independently, and make sure that the fiduciary, the board of trustees or the institutional trustee, actually helps you create an independent process where you elect the directors. So you don't just have I'm a director this year, I'm going to be a director for life kind of a situation. If you do that, I don't think there's any real substance to your corporate governance, and I think it's a mistake. So word to the wise there, just have outside directors involved in the process, have a monitoring that goes on an annual basis, and go ahead, Scott.
So in this instance, if it were 100% ESOP-owned company, are the board of directors effectively 100% elected by the ESOP trustee?
Correct.
Who's appointed by the board of directors?
Yes, which is the circular process, which is why I like to have some outsiders on the board of directors, so you don't have this perpetual, I'm going to appoint Jane and John and Dean and Sally and the company and continue to have them on the board of directors forever without having some.
Is that a major Department of Labor concern? Or?
It is. They have wanted to. In fact, the case I was talking about in Hawaii is all about the founding shareholders staying actively involved in the business and never giving up the day-to-day management control, but they gave up the control of the company to the institutional trustee who had to approve them being on that board of directors. So it is a big issue.
Can you talk to who makes a good candidate to be an outside director at a ESOP company?
Yeah, that's good question. And it's become a cottage industry. There are probably 25 different people like that. I think they need to know something about just general corporate governance. You don't need to be a lawyer, you just an industry person. You don't have to be an industry person in that particular business. You've got to know enough about employee ownership and ESOPs and how they work, and have experience in independently managing businesses so that you understand how an independent process works. And I think it's important to have more than one candidate. Don't just go out and pick your friend or your best buddy. Create a slate of people. That's why I suggest a nominating committee so you have some real viability to the whole process. I have long gone over, but in part because of all your great questions, so I really appreciate it. I'm going to introduce Nellie real quick. I've got a piece of paper, a quick one.